The market just delivered a violent V-shaped recovery right into Friday's close, but that explosive momentum has suddenly slammed into a wall. Across the board, major indices have stopped climbing and are now heavily consolidating right at their recent local highs. For traders looking at this setup, the central tension is clear. Is the market just catching its breath before a massive breakout, or is this structure signaling total exhaustion? Our objective today is to answer that question and build a definitive, objective trade plan for the Monday open August 10th. We will build this plan using a strict top-down methodology. We start by analyzing the technical price structure, move into internal market breadth, and finish by checking the fundamental macro catalysts. Keep in mind, what follows is a breakdown of my personal trading methodology. This is an educational analysis, not financial advice. You are solely responsible for your own risk management and execution. Surviving the open on Monday requires abandoning all directional bias. We have to rely entirely on a cold, objective synthesis of the raw data. Let's start with the technicals, looking closely at the price action driving the tech-heavy Nasdaq. This chart shows the US 100 index on a 1-hour time frame. Look at this aggressive gap higher kicking off the recent sequence. Immediately after, the upward drive halts. The price action flatlines, forming a tight, sideways balance area right around the 29,722 level. We need to see if this consolidation is isolated to tech, or if it's a structural feature across the broader market, so let's check the S&P 500. On the S&P 500 1-hour chart, an identical sideways flag formation occurs at 7,757. But price isn't everything. Looking down at the volume profile, notice how as price moves sideways, the volume bars drop off a cliff. In technical analysis, this specific phenomenon is known as volume decay. When a market accepts higher prices but the volume simply dries up, it indicates a severe lack of institutional conviction to push the market any higher. The technical evidence points in one direction. This is a market pausing to catch its breath, not a market gearing up for an aggressive sprint. To understand what is actually keeping the price elevated, we must transition from the high-level indices and dig deeply into the internal mechanics of the overall market. This S&P heat map shows heavily concentrated buying pressure in tech and consumer cyclical, relying on megacaps like Nvidia and Tesla. Contrast this isolated strength with the financial sector's prominent red blocks. Credit services are a heavy drag, with Visa and MasterCard down over 2%. The top-line index level is hiding a stark divergence. This rally is supported entirely by highly isolated momentum, not broad economic health. What we are looking at is a rotational reality. Capital isn't lifting all boats. It is simply cycling into a handful of tech safe havens to keep the index afloat. Because broad-based participation is missing, any potential upward breakout is highly fragile. If those few megacaps stall, the structural support vanishes and the breakout fails. Internal market breadth firmly contradicts the strength we saw on the surface index charts. It is a clear signal of extreme caution for aggressive buyers. Finally, we need to check the fundamental drivers. We need to know what economic data releases are on the horizon but could actually force institutional capital to enter the market. This economic calendar maps out upcoming volatility triggers. Focusing on Monday and Tuesday, notice the complete absence of high-impact Tier 1 data for the US dollar. This empty period creates a macro volatility vacuum. There is no scheduled news to force traders to act. Shifting down to Wednesday and Thursday on the calendar, we have massive inflation data looming. Both core CPI and PPI metrics hit the wire back-to-back. Large funds and institutional players are not going to deploy heavy directional risk on a quiet Monday right into the teeth of Wednesday's critical inflation data. Because of this calendar setup, Monday's price action will not be driven by fresh capital. It will be dictated entirely by the weak technicals and narrow breadth we just mapped out. Without a fundamental catalyst to inject volume, the market is structurally trapped within its current consolidation range until Wednesday morning. We now combine our three pillars of evidence: volume decay on the charts, rotational vulnerability in the breadth, and a macro vacuum on the calendar. The resulting prediction is straightforward. Monday will see low conviction, choppy, range-bound price action. Let's map the boundaries on the S&P 500. We draw a resistance box across the top wicks and a support box across the bottom wicks of this consolidation. With volume dried up, expect price to bounce between these boundaries. This establishes the primary negative rule for Monday's trade plan: do not trade breakouts. Attempting to trade a breakout in a low-volume, pre-macro environment almost always results in a trap. The structural support to follow through is not there. Instead, our primary active strategy is mean reversion. We execute mean reversion by fading the extremes. We look to sell when the price nears the resistance box, and we buy when it nears the support box, expecting the price to revert right back to the middle of the range. The ultimate goal for Monday and Tuesday is capital preservation. You have to keep your powder dry for the volatility coming midweek. The true directional opportunity will reveal itself after Wednesday's CPI data drops. Monday's task is simply to extract range-bound profits while strictly managing your risk.